What if I told you your bank doesn't just make money from interest? In fact, interest is only the beginning. Every time you swipe your card, every time you take a loan, even when your money just sits there, your bank is quietly earning. And the craziest part? They're often making money with your money. Today, we're breaking down every major way banks make money, simply, clearly, and without boring financial jargon. Let's open the vault. Banks are basically middlemen. They take deposits from savers, lend that money to borrowers, and they profit from the difference. This is called net interest margin. Example, you deposit $1,000. The bank pays you 2% interest. They lend it to someone at 7%. That 5% difference, that's profit. Main loan types: mortgages, auto loans, personal loans, business loans, or credit cards, which are the most profitable. Credit cards are gold mines. The average credit card interest rate in America is over 20%. Miss one payment? Late fees plus penalty APR. Banks love revolving debt. Every time you swipe your card, the store pays a fee, usually around 1 to 3%. If you buy a $100 item, the merchant might only receive $97. That $3 split between the bank, the card network like Visa and MasterCard, and MasterCard. Millions of transactions per day, tiny fees, massive profits. Even if you pay your credit card bill in full, your bank still makes money. Banks charge fees for almost everything. Overdraft fees, ATM fees, monthly maintenance fees, late payment fees, wire transfer fees, foreign transaction fees. Overdraft fees alone generate billions annually in the US. You swipe when you don't have enough money? Boom, $35 fee, even if you were short by $2. Some banks have reduced this recently due to regulation pressure, but fees are still a huge revenue stream. Banks don't just lend your money, they also invest it. Common investments, government bonds, treasury securities, corporate debt, short-term markets. For example, banks often buy U.S. Treasury bonds. They earn safe interest, sometimes higher than what they pay you. Low risk, steady return, massive scale. Big banks do much more than retail banking. They help companies go public, IPOs, merge with other companies, raise billions in capital. For example, firms like JP Morgan Chase or Goldman Sachs earn huge advisory fees. A single IPO can generate tens or hundreds of millions in fees. This side of banking is less visible to everyday people, but extremely profitable. Banks also act like financial supermarkets. They sell insurance, mutual funds, retirement accounts, and wealth management services. They earn commissions, management fees, and advisory fees. Even your 401k can generate revenue for a bank. Assets under management equals predictable yearly income. Here's where it gets interesting. Banks don't keep 100% of your deposit in the vault. They keep a fraction and lend the rest. This system is called fractional reserve banking. It allows banks to create more loans than actual physical money. That's how money multiplies in the economy, and it's one of the most powerful financial mechanisms ever created. So let's recap. Banks make money from loan interest, credit card debt, swipe fees, service fees, investments, investment banking, financial product sales, and fractional reserve leverage. They don't just store money, they use it, multiply it, monetize it, and the more money moves, the more they earn. Next time you open your banking app, remember, your money isn't sleeping.